Ever wondered how companies account for the huge costs of dismantling mines, oil rigs, or factories once they've reached the end of their life? Today, we're diving into decommissioning provisions and costs, also known under ASPE as Asset Retirement Obligations. By the end of this video, you'll understand when to recognize these provisions, how to measure and update them, how to record changes over time, and the key IFRS versus ASPE differences you need to know for both your exams and real-world accounting. All right, let's get started. Before we jump into recognition and measurement, let's start with the basics. A decommissioning provision represents a company's present obligation for future costs to dismantle, remove, or restore a tangible asset or the site on which it sits. Think of it as a cleanup cost. For example, a mining company restoring land after extracting minerals, or a power plant dismantling its equipment at the end of its useful life. These are different from regular liabilities, like trade payables, because there's uncertainty around timing and amount. Sometimes the decommissioning might not happen for 10, 20, or even 30 years. Under IFRS, this falls under IAS37, Provisions, Contingent Liabilities, and Contingent Assets, while under ASPE, it's covered in Section 3110, Asset Retirement Obligations. Now that we know what they are, let's talk about when these obligations should actually be recognized. Under IFRS, you recognize a decommissioning provision when all three conditions are met. 1. There's a present obligation, legal or constructive, from a past event. 2. It's probable that settling the obligation will result in an outflow of resources. 3. A reliable estimate of the obligation can be made. At the same time, the related asset is recognized under IAS16, Property, Plant, and Equipment, because decommissioning costs are part of the asset's total cost. Let's make this more concrete with an example. Imagine Green Peak Forestry Limited builds a temporary bridge on leased land to access logging sites. The lease agreement requires them to dismantle the bridge and restore the riverbank once operations end in 5 years. When the lease begins and the bridge is built, the obligation becomes present. It's probable the company will need to spend money to remove the bridge, and management can reliably estimate the cost, say $250,000 for dismantling and restoration. So, Green Peak Forestry recognizes a decommissioning provision, recorded at its present value, and adds that amount to the cost of the bridge asset. Now that we've established when to recognize it, let's move into how to measure it initially. Decommissioning provisions are initially measured at the best estimate of the expenditure required to settle the obligation, discounted to present value using a pre-tax rate that reflects current market risk. For example, Green Peak Forestry estimates the future cleanup cost at $250,000, expected to be paid in 5 years, and the company's pre-tax rate is 4%. Using the present value formula, PV equals 250,000 divided by 1 plus 0.04 to the power of 5 equals $205,482. Here's the journal entry. Debit bridge asset, PP&E, $205,482. Credit, decommissioning provision, $205,482. This adds the cost of dismantling to the bridge asset and records the obligation. If the underlying asset were leased instead of owned, the decommissioning cost would be added to a right-of-use asset under IFRS 16. Now that we've measured the provision, the next question is, how does it change over time? Once recognized, both the provision and the asset must be updated over time. On the liability side, at each reporting date, companies reevaluate their provision based on new estimates, timing, or discount rates. Also, since time is passing, the present value increases, and that increase is recognized as interest expense. Continuing with our Green Peak Forestry example, each year, interest expense equals 4% times opening balance of the provision. That interest is added to the liability until it reaches the full $250,000 after 5 years. On the asset side, The decommissioning cost that was capitalized to the asset is depreciated over the asset's useful life. So, if the bridge asset includes $205,482 of decommissioning cost and has a 5-year life, the depreciation would be $205,482 divided by 5 equals $41,096 per year. And here is the journal entry. Debit depreciation expense $41,096. Credit accumulated depreciation $41,096. Through these two adjustments, interest on the provision and depreciation of the asset, the company systematically recognizes the cost of future restoration over time. Now, what happens if new information changes the estimated cost or timing? Let's look at that next. Estimates can change, and they often do. Under IFRS 1, any changes in the expected cash outflows or discount rate must be reflected by adjusting both the asset and the liability. If the adjustment would reduce the asset's carrying amount below zero, the difference is recognized in profit or loss. And if the new carrying amount exceeds the recoverable amount, an impairment loss must be recognized. Let's say Harbor Cement Co. initially estimated $2.5 million in decommissioning costs for a plant, but later revised it to $3 million. The provision increases by $500,000, and the same amount is added to the plant asset. This increase is then depreciated over the remaining life of the plant, and interest expense in future years is recalculated using the new carrying balance. Smooth and consistent, that's how IFRS ensures the statement reflects reality as estimates evolve. Next, let's see how the accounting wraps up when the decommissioning is actually completed. A decommissioning provision is removed from the books, or derecognized, when the cleanup has been completed, or the obligation no longer exists. If the actual cost differs from what was estimated, the difference is recorded as a gain or loss. For example, Green Peak Forestry recorded a provision of $250,000, but the actual cleanup cost ended up being $275,000. That extra $25,000 would be recorded as a loss. If instead they only spent $220,000, the $30,000 difference would be a gain. Now that the project is cleaned up and off the books, how do these items appear in the financial statements? Decommissioning provisions are usually shown as long-term liabilities on the statement of financial position, since the cleanup typically occurs well after 1 year. The decommissioning costs themselves are included within the related asset, for example, under PP&E, or right-of-use assets. Disclosure notes must include important assumptions such as expected timing of outflows, discount rates used, and sensitivity of the estimates to change. Now that we've mastered IFRS, let's compare it to ASPE. Under ASPE 3110, decommissioning provisions are called Asset Retirement Obligations, AROs. While the core principles are similar, there are a few key differences to remember. IFRS recognizes both legal and constructive obligations, while ASPE recognizes legal obligations only. IFRS, unwinding of discount recorded as interest expense. ASPE, on the other hand, unwinding recorded as accretion expense. Operating. IFRS uses risk-adjusted discount rate and ASPE uses risk-free rate. In IFRS, you must recognize once a reliable estimate can be made. In ASPE, you may delay until a reasonable estimate can be made. Example: Skyline Chemicals Inc. builds a chemical plant costing $20 million and estimates $4 million to dismantle and clean up in 20 years. Using a risk-free rate of 4%, the present value of the ARO is $1,825,548. Journal entries would be debit plant $21,825,548. Credit cash $20 million. Credit asset retirement obligation $1,825,548. Each year, Skyline records amortization expense $21,825,548 divided by 20 equals $1,091,277. Accretion expense, $1,825,548 times 4% equals $73,022. That's how ASPE handles the passage of time. Slightly different presentation, same underlying concept. And that's the full picture of decommissioning provisions and costs, from recognition and measurement all the way to derecognition and disclosure. Understanding this topic is key not just for the CPA exams, but also for industries like mining, oil and gas, forestry, and manufacturing, where environmental obligations are significant. If you found this lesson helpful, make sure to like this video, subscribe to Canada Accounting Insights, and turn on the bell so you don't miss upcoming breakdowns on IFRS, ASPE, and real-world accounting cases. Thanks for watching, and I'll see you in the next lesson.